The short-term rental loophole is one of the most powerful tax strategies for high-income W-2 earners right now. But there's a catch. If you don't meet every single one of the qualifications, the whole strategy falls apart. Your losses will stay trapped as passive, they won't offset your W-2 income, and you're stuck with a rental property that isn't providing you the tax savings that you're looking for when you bought it. I'm Ryan Carrier. I'm a CPA and founder of Carrier Tax Consulting, and I work directly with high-income earners who are looking to use real estate tax strategies like the short-term rental loophole to offset their taxes. And the number one reason that I see that this fails is because people will miss one qualification that's going to destroy all of the benefit here. So in this video, I'm going to walk you through every qualification that you need to meet to use the short-term rental tax strategy or loophole step by step, so there's no confusion about what it takes and how you can become eligible. So the first requirement, and this is really the foundation of this strategy, is that your property has an average stay of 7 days or less. This is essentially what qualifies it as a short-term rental in the eyes of the IRS and separates it from a traditional long-term rental because they have an exception in their regulations that are going to treat this as not being considered a normal rental activity. But if your average goes above 7, now you're not going to be able to qualify for this. So when we calculate the average stay of 7 days or less, you are looking at the entire calendar year. You're effectively taking the total days that it was rented divided by the number of stays that happened. So you can have stays that are above 7 during the year as long as your average for the entire calendar year is 7 days or less. And when I say 7, that is 7.00000. You get the point, right? So you do need to be careful about having any sort of extended stays because those could push your average up if you're allowing them. You just need to keep track of what your average is throughout the year. It's not based on your intent, and it's based on true stays that you had throughout the year. So one thing that could be an issue is if you bought a property that already had some stays included that did tip you over to being above the average stay of 7. Or you had some longer stays and you weren't keeping track of them throughout the year of what your average was going to be. And by the end of the year, you think that you're going to expect some shorter stays, but they don't materialize. So what I would recommend is that if you're going to have stays that are above 7, you need to constantly be calculating the average, and ultimately you should set a maximum number of nights that guests are allowed to book so that you ensure that you don't accidentally go over by a significant portion. Don't ever, in my opinion, don't ever have a maximum stay that is not set at all. No limit. Okay, one last thing on the average stay of 7 days or less. As we use the word average, keep in mind that has a connotation that we have several stays throughout the year, okay? So if you have intent on renting the property, you place it in service, but you get 0 stays throughout the year, that calendar year that you're trying to use the short-term rental strategy, this will not work. You don't have an average and you don't have any stays. It doesn't work. But if you have 1 stay, you at least are showing that you have some average, probably below 7, let's say of 1 5-day stay. That's better than 0, but you are taking on a substantial amount of risk. And one way to potentially reduce that is to then have the following year or years continue to keep that average stay of less than 7. But just know, you're hearing it from me, there is a lot of risk of doing that because you don't have a couple stays. You're just gonna have 1 stay that is risky. So ideally you have at minimum 2 different stays. That's how you stay safe and do this legally and do this without a lot of scrutiny. I have actually spoken with people in the past that thought that they could do that, and as long as they placed it in service before the end of the year and they used it next year for stays, but they got 0 this year, they thought that they were going to be able to still do this. So please do not do this. It is a common misconception out there. All right, so that's the first qualification. Now we're going to walk through 2 more that you need to know about in just a second. And making sure that you meet all of these qualifications is what I do with my clients at Carrier Tax Consulting. We don't just tell you to buy a short-term rental and then hope that it works. We plan this strategy out with our clients in advance so that every qualification is accounted for before you buy the property. And if this sounds like what you're looking for, you can find a link in the description below to book a call with me. All right, let's get to the next one. The second requirement is material participation. And if there's any issues in an IRS audit, it is primarily going to focus on here. You have to personally materially participate in your short-term rental. If you don't, any losses you generate from the short-term rental are going to be considered passive by default. And the whole point of this strategy, all the benefit, the tax savings is gone. Now, I've done a full video on material participation, the 100-hour rule, and so forth, so I'm going to keep this part brief, and you can go watch some more of my videos as well on that topic. But I want to make sure that we capture this in this piece as a high-level concept. So first thing to mention, the IRS has given us 7 material participation tests, but you only need to meet one of these. The most common I see my clients use are either the 100 hours and more than anyone else test or the 500-hour test. And even of those two, you can imagine that most clients are going to shoot for the one that's easier, being the 100 hours and more than anyone else test. So first, what are some categories in general of time that does count? Well, think of it first as some of the managerial time, okay? If you're doing things like talking to guests, if you're setting up the listing for the advertisement, if you're managing cleaners, if you're managing contractors who are doing the work for you. And then you have a second major category, which is some of the physical work, like doing any sort of repairs yourself, improvements yourself, cleaning the property, setting up the furnishing, and things like that. Ultimately, it comes down to you're involved in the day-to-day operations and running of the business. A couple categories of things that do not count are going to be investor-like activities, like reviewing financial statements from a property manager, or simply setting up a LLC or a bank account, or time spent that your cleaners are putting into your property, or a handyman or a co-host. Any time that they put in does not count towards your time. You're actually competing with them if you're going for the 100 hours and more than anyone else test. I'll also add that generally speaking, travel time does not count. That's a very risky category to talk about. And also education, like watching this video, going to a conference about real estate, or listening to a podcast, all that general education stuff is not going to count. But for those of you watching who are married, if you're married filing joint with your spouse, you can combine time together. And a common misconception I get here is that both spouses have to get 100 hours. That's not true. It could be, if you were just using 100 hours as an example, it could be spouse A gets 50 hours and spouse B gets 50 hours for a combined 100 hours. So for couples that I work with, which is the majority of my clients, I typically see my clients going to a new property they acquire and spending about a week there. They're working on furnishing it, they're working on the advertisement, the description, they're doing the initial clean, they're doing a couple repairs and improvements, things like that, to get them and bolster up their close to 100 hours in literally 1 week. That's really not an uncommon situation that I see, and that is a huge recommendation I have for most clients. Trying to get 100 hours and more than anyone else simply by being remote and trying to only manage it yourself without going there physically is going to be hard with a single property that you acquire. Now, last thing I want to make sure that I mention on this video as well. Keep in mind, the 100-hour test is 100 hours and more than any other individual person. The simplest way I like to explain it is think about it like a bar chart. If you think about a bar chart and you have the most amount of time and everyone else's time is less than yours, you win. You need to have more than any other individual. So if you hire a cleaning team and each cleaner, A, B, C, gets 35 hours, 35 hours, 35 hours, you've won, okay? Because it's spread out per individual person. All right, let's keep moving on. So the third qualification sometimes catches people off guard, and this is where I really slow down with my clients. A lot of people are aware of the first two qualifications. The average stay is less than 7, and they need to materially participate, and they get that in their head and they say, that sounds easy. But even if you meet an average stay of less than 7 and you do the time to get material participation, if you do not document that with a time log and you do not report it correctly on your tax return, it's all useless. Documentation is extremely, extremely important. And I harp on it because if you ever get audited, whether in an IRS agent's kind of one-on-one or you're going into tax court because you're contesting what the IRS agent concluded, you are the one who is responsible for providing proof and documentation, not the IRS. This is not like a criminal court case where you are innocent until proven guilty. You are the one who has to support that you have an average stay of less than 7, materially participated, using documentation to show them that you have a stance in what you're claiming on your tax return. So you need to keep contemporaneous time log to make this work for you. At a minimum, you need to keep the date, the amount of time that you spent on the activity, a description of what you did, who was working on it, and where, which property were you doing. Do not try to reconstruct this at tax time or especially when you're getting audited. Okay, if you try to reconstruct this when you're getting audited in 2 to 3, 4 years, whatever it might be, that's going to look very fishy. Now for reporting, just a couple comments. I don't talk about this a lot. You in general are going to report a short-term rental using the short-term rental strategy on Schedule E, not Schedule C. The only time you would report a rental on Schedule C is if you are providing substantial services. Now, for most of my clients, they're not doing that because that would be things like daily cleaning, daily breakfast, excursions, things like that. And if you report this on Schedule C and you're continuing to show a profit, guess what? Your tax preparer is probably automatically having you pay self-employment tax. That's the additional 15.3% tax. So not only is this a reporting issue, it could potentially be hurting you in terms of paying more self-employment tax. A couple other notes, you're also going to want to have this be depreciated over 39 years instead of 27.5. That's a common issue that I see with other tax preparers who don't specialize in this. This is basically like a hotel motel instead of a long-term 12-month lease. And the last thing I'll just mention for reporting, on Schedule E, there's different numbers for the different types of properties. This is going to be type 3, okay? Type 3 literally shows vacation, short-term rental. I so commonly see other people who don't know what they're doing or people self-filing their tax return. They will just put single family home. That's number 1 type. This is a type 3. Designate that, be very specific with that so that there's no confusion. And the last thing I will tell you, I also commonly see people accidentally claim this as real estate professional status, which is a single line at the end of Schedule E page 2, which shows the real estate professional designation and the amount that you're taking in a loss specifically on that status. So if you do this all correctly, if you get this documented, if you actually materially participate, and if you get the average stay of less than 7, you legally are going to be able to use the short-term rental strategy and you can sleep well at night. If you miss any one of these qualifications, this will not apply to you. Now, if you found this video helpful, please like and subscribe to the channel. And if you want to see more of this kind of content and you want to see me break down what this could look like for a $500,000 W-2 income earner, I'll link that video up here on the screen and I'll see you on that video.